Hello everyone, can you hear me? I think should be fine the settings. It's just that I wonder is the volume too low or not. Should be good, I guess. Let me check, yeah. Okay, I think should be fine. So we will just start on today's sessions. Good evening, everyone. I hope you guys are doing well for this week. Yesterday in Malaysia, it was a Deepawali holiday, so there are many people who is taking leave for the day, and then yeah, it's quite lonely to just stay in the office at this hour. And I'm Junlo, and welcome back to the weekly free financial courses. And you can call me Jay or you can call me Xiaohe 老师. It's all up to you. And still in this class, I'm not going to sell you some other courses. I'm not going to upsell you, and then I will not collect any personal information or money from you. And this is 100% free courses so that I hope you can enjoy it, and hopefully we can become a financial expert and make some great money together. And in today, we these courses will be kind of like a mixture of a boring and tiring theory part, and then together we'll be mixing some exciting strategy to be applied on different capital size. So I'll try to get you all prepared slowly instead of just rushing into the market immediately, as I think that the more knowledge you have, the easier for you to make money in the market. So um, I think that everyone need to be prepare mentally, and also filled with the knowledge so that we can actually try to get rich fast. Get rich fast is possible, but it's very difficult, and I need you to be prepared in both. But in the other way, accumulating the wealth in a slower manner will be much more easier compared to that. But I believe that most of you do have the passions and love to make the huge money and have the urge to do so just within a short period of time. So if you think the exactly same way like I did, I will be happy if you can join and follow me all the way to achieve financial freedom. So let's start on today's topic. The topic is options focus and different strategies on principle. In the last class, we have talked about how do we analyze the stock with different approach and using the options as a supporting tools for entry and enjoy the benefits, the leverage that the options can bring us. But in today's class, we are going to study deep into the option instead. So when we already have the stock targeted, which options are we going to choose among all of those? And what will be the indicators that we can check on to select the most suitable options will be what are we going to study for today. And then, which is what we are going to cover next, the grit indicator. Many aspiring investor and trader overlook the actual important basics, like in today's cases, the grit. They do that instead of just being on Wall Street bet all days long looking for the next 10x meme coin. So we are going to take everything that we learn and make sense our trade so that we won't lose in the progress and don't even know why the reason that we are losing money. So after we going through all of those, we will look into how to apply the grid to filter out the most suitable options for different strategy on different capital size. so we'll be in a more favorable positions compared to the others. We will also talk on how to trade options with a smaller account, and there will be two ways to do so. For those who have a higher risk tolerance and want to enjoy the excitement of riding the stock price, we can choose the risky way, which is aim for flipping the account. But there is also criteria required instead of just betting your hard-earned money into it. So do stay along with me. In the other way, we will also talk on how to accumulate the small gain to grow our account in a more steady way. So it will allow us to have a bigger room for mistake and losses. Different strategy will be suitable for different persons, so make sure you understand the preference before making any trades. And then for those who have a large account, I will also suggest to do it in a safer way instead, which is focus on collecting the premium as an interest. This is what only premiums can do instead of just trading with other financial instruments like CFD and futures. Only options you can collect the interest. You can collect the premium as an interest. You can do a short positions and then you make the premium instead of paying the fees. So let's begin to talk on grids first. I will try to deliver the informations and make sense out of it through examples so that you can actually understand it, but not just memorize it. And so get yourself ready and we will start on it. Grids is a terms of it's very complicated explanation. It's a terms for multiple measuring factors which can determine and predict the price movement of the options premium, which allow you to understand the risk exposure of those options. Yeah, it's quite long. So translation into the simple English, these grids, and there are 4 of them, which we are going to go over in this class, are there to help us to measure how the options premium price will be affected in the future. The option value will be affected in the future based on different things. And it won't really be that hard, so don't worry. Let's get on to what the grids actually cover. So the grids can be broken up into 5 components. The first one is delta, and is a measure of the changes in the price in the option price, which is the premium resulting from the changes in the underlying asset. Yeah, bear with me. For now, first, we will go into the details and the example to make sure that all of you can understand. And the second one will be gamma, which is the measure of the delta rate of changes over time, as well as the rate of changes in the underlying assets, and help to forecast the price movement in the underlying assets. Next one will be delta. It measures the changes of the options value due to the time remaining. In the other words, the time decay in the value of the options or the premium. And the fourth one will be vega. It measures the risk of changes in the implied volatility or the forward-looking expected volatility of the underlying asset price. So if you do remember what I said in the beginning, there is actually 5 of them, but in this class, I was just going to remove the row as it represents the relationship between the options and the risk-free rate. And then the interest rate itself doesn't change quite often. So for me personally, I think it's okay to just ignore it and then ignore the effect that is played because it's normally stay the same. Okay, so we will just go into the detail and then we'll go through the example bit by bit, step by step, to make sure that all of you can understand all these grids are, and then we will just apply on how do we apply our understanding on this grid, and then we will just create a strategy to make sure that all these grids are on our side, and then our position will be more in the more favorable conditions. So delta will be used to determine how much the price options of a particular contract will move, either up or down depending on how the stock price of the underlying stock price move. So that if the stock price go up, well then how do we know what will be the option price will be? The answer is we use delta. Delta is defined as the expected changes in an option's price relative to $1 move in the underlying stock price. So again, delta is going to help us to determine how the option price will move for every dollar move in the stock. Delta value, you will notice it will go from 0 to 1 when we are talking about calls, and it will go to 0 to -1 when we are talking about puts. And then the delta number is actually the value that the premium price will increase or decrease when buying calls. And if the stock move up by $1, and then the option price will move up by the delta number. So if the stock move down by $1, then the option price will move down by the delta number. So when we are buying puts, it's the opposite. So that if the stock goes down by $1, and you buy put, that's a good thing because the option price will go up by that negative delta number that you see. And then if the stock price goes up when we have puts in the options, and then the put option price will be go down. It's a reverse situations. So that here is the example. If you have an option with a delta of 0.5, then for every dollar that the underlying stock price move up, and then the option price will increase by 50 cents. So let's say we have a stock trading at $100 and an option price of $2 with a delta of 0.5 in this case, and we are on the call side. So now when the price rise by $1, the premium will actually goes up by 0.5. So it will make it $2.50. As simple as that, just like that. So if the share price goes up by $2, you can just use 2 to multiply it by 0.5, and that will make it a $1 rise in the premium. So we will just get you into the real life example. This is the interface that I will be taking on from Usmart. And then you can just, I will use NVIDIA as an example. You can just simply open the Usmart apps and then search for NVIDIA. Then you can check on to the second title on the bar, just right below the stock name. And then you can select your desired options with different expiration dates. In this case, we are looking for NVIDIA options expiring on November 29, and then 2024. And then with the current share price of 141, when at the time that I capture $141.25. Let's say that we are going to select the nearest call option, the one with the of $141. And you can see from the latest premium is actually $10.40. And then it have a delta of 0.5. So what happens if the share price goes up by $1? In this case, if the share price goes up from $141.25 to $142.25, which is a $1 increase in the price, what happened to the premium? The premium will goes up by the delta value. So it will make it a summation of $10.40 plus on the 54 cents and make it $10.94. As simple as that. So for every dollar rise in the share price, the premium goes up by the delta value of 54 cents. So if the share price goes up by $2, the premium will goes up by $1.08. And I have made a comparison in the rise in the percentage so that you can see the leverage effect. And you can see that from the share price itself is actually have a rise of 0.7%, but you can see that the premium is actually having a rise of 5%. So that this is the effect of the options. So instead of just trading the normal stock, you can actually trade the options to have a better gain and leverage the gain. This is why most people love to trade with options. They look for the multiple X in the gain instead of just a few percentage point. So if there's another case when the share price goes up by 10% or 50 or 20%, usually the option value will just multiply by many times, many X. So here's a little tips. Delta is also commonly used when determining the likelihood of the options being in the money at the expiration. So for example, an out of the money call options with a 0.2 delta has roughly a 20% of being in the money at the expiration. Just to make it simple, actually is represent that actually delta also represent the winning rate of the options at the time of the expiration. So you can see that for this case, the delta is 0.54, which make it a 54% that the call that you bought will be at the winning stage at the time of expirations. So this call option is actually have a 54% winning rate. And you can see that if you goes down by the number of the strike price, like 137 in this case, you can see the delta actually increased to 0.603, which means if you are choosing to buy an options with a lower strike price, which you can play effects immediately, and then it's actually have a much more higher rate compared to the one with the strike with a higher price, because it is already lower than the current market. So now that we understand the delta and how the price of the option is affected by the delta, we can now understand gamma. Because gamma affect the delta, and then the delta affect the price of the option. So through this very weird chains of event happens, delta actually affect the price of the option. So okay, all right. Gamma is actually the rate of changes of the options delta related to 1 point move of the underlying stock. I think we better just move on to the example, is because when we're going through the example, it's much more easier for us to understand the whole theory behind instead of just explaining in words. So in this case, which is the same case, and then here we go back to the same example. We have a stock that is trading at $100 and the options with a premium of $2, and then the delta is 0.5. So when the share price goes up by $1, the premium goes up by the delta value and make it $2.50. So now we add on the gamma. The gamma for the options is 0.05. So now let's say that the $100 stock increased to 101, which is 1 point move from the stock. The gamma of the options, which is 0.05, will affect the delta of the options, which is the 0.5. So the 0.5 add on the 0.05 will, now you get the delta become 0.55. So actually you can see that the delta is actually to speed up the growth of the options value, and the gamma is actually become an accelerator that increase the speed. So let's move on to the real life example. So when we let's see, so the gamma get to add to the delta, and then the delta is now higher. So that means when the stock move another $1, and the delta will affect the premium price even more. So now this case, when there's another dollar move in the share price, the premium will increase by 0.5. 0.55, 55 cents instead of just 50 cents, and make it to $3.05. So you can see that the growth in the options is actually increasing bit by bit. So there's a word that say that the delta is actually the speed of the option changes, and the gamma is the acceleration to the speed. So now let's look at the example from our brokerage. We are taking a look at the same NVIDIA options. The $141 call expiring on November 29. So this option is priced today at $10.40. With a $1 rise in the share price, the delta take place. And then we will have another accelerator, the gamma. With the gamma of 0.016, the delta will then add on to the gamma value and goes up, which will make it 0.556. So if there's another dollar increase in the share price, the premium will actually goes up by the latest delta value, which is the 0.556. So, and it make it become $11.50. So if you are buying the put option, it just works the exactly same way. It's just that the premium will goes up higher when the share price drop. And it just that simple. So to avoid things getting complicated, we will only focus on the call options for illustration today. And then if there's anything you can't figure out, and feel free to just contact me after the classes. I will explain to you step by step, bit by bit. No worries. I will leave my contact at the end of the sections, so you can just feel free to contact me. And now we already understand delta and also gamma. The one very important thing to understand about options is that all options will lose the value as they get closer and closer to the expiration dates. So if other things remain constant, the option value will actually depreciate across time. So when you are buying the options, you're actually fighting the time. You are on the opposite side of the time. And then the option is always losing the value every day, every week, every month until expiration. And until there is only the intrinsic value of the option left. This is still to that theta, or we call it theta decay. Theta is actually referring to the rate of the decline in the value of the options due to the passage of time. So the theta is actually usually expressed as a negative number, and the number tell you that how much the options value will lose every day until expirations. So just take a look at the example. The share price of the stock is $100 and the options is pricing at $2 with the delta with the theta of negative 0.2. Do remember that now the factor affecting is not the changes in the price anymore, but the time. So we will factor in the time. Let's say that in this example, this is on day 1. So on the next day, will the share price remain unchanged? In the previous example, the share price increased. But in this case, it remained unchanged, but the only changes is the day. And then the data will now do its thing and deduct the value of the premium. So the premium of $2 will now become $1.80 because it's deducted by the value of the data. So let's move on to the real life example. Still the old friend, our NVIDIA options. So at the time that I captured the premium is pricing on $10.40, and the data is negative 0.172. Okay, so if there's no changes in the share price today, which is today will be on day 1, and there is no changes today, and the data will then depreciate the value of the options by 0.172. So on the next day, the premium will actually drop to $10.23. So even though there's nothing changes in price, your options will still depreciate bit by bit until it lost the value, until the expiration date. So hereby, I will just give you some hints on how to utilize this data in a better way. So if you just open the UseSmart app and you check on any options, you can see that if you further out the expiration date of the options, the data decay number will be much less negative. So for this case, the option is expiring on November 29. So if you further out like options expiration date that is for on the next year, the data might become negative 0.1 or even smaller. So if you are going to buy the options, I would suggest you to choose the options with a further expiration date. The options with the expiration date further out in time will lose less value per day due to the data decay. So when the price does increase and the stock and option price increase, and hopefully the increase in due to the changes in the price able to higher than the data decay, able to cover the decrease in the time value, and then you can make a profit. We must stand on the side with while minimize the data decay. So choosing options with a further out expiration date will help you in that. Or you can, in the other way, you can also see how selling options is a more favorable position because you can sell the options and just let the data to do its thing. Sell high first and then you can just buy low. So even though there's nothing changes in the share price, the value of the options is actually decreasing bit by bit. So you can actually do sell high now and then you wait for the data to do its thing and then you can buy low later on. So just closing the positions and then you can log on your gain. So when the data do its thing, you as the option seller will make money. Yeah, so this is for the data. Now we will go into Vega. Vega is actually represent the amount that an options contract price changes based on 1% changes in the implied volatility. For delta is actually the changes in price, the changes in the share price. And then gamma is the acceleration of the delta. Theta, the just now theta is the time decay. The factor affecting is the time. And then now we come to Vega. Vega is actually based on the implied volatility. So just like all the other grids, the option price is affected by something else. So in this case, the something else is actually the implied volatility. Now I think that you might start to get the hang out of it. So it might be a little bit confusing, but you're actually doing great because it's a quite complicated topic. So if you are still here, just try to keep going with the classes and trust me, this is the last grid. And we will move on to how to utilize all of those. So with the example, let's move on to the example. With the example, the share price is $100 and then the premium is costing $2 each. And then now we have Vega, the Vega of 0.2 and the current implied volatility of the stock fall on 20%. To just simplify the calculations, the share price will still remain the same. So that the data won't come into place. So then for every 1% move up or down in the implied volatility, the option price will move up or down by the amount of Vega. So when the implied volatility in this case is rise by 1% to from 20% to 21%, the premium will become $2.20 because it is a goes up in the implied volatility, so that the premium will also goes up. So now let's get back to the NVIDIA case, the old friend, NVIDIA. And you can see that the current implied volatility of NVIDIA is actually 63.31%, which is a very high figure. It means that the market is actually expecting NVIDIA to move a 63% within the following years. We already talked about the implied volatility together with other volatility measurements in the previous class, in the class last week. So that if you are interested, you can check back on the recording, or you can also wait for the next cycle of the lecturing classes that we might go over again from the beginning. So let's get back to the content. The Vega in this case is actually 0.162. So with the share price remain unchanged, and then if the implied volatility goes up by 1%, the premium will goes up by the Vega value of 0.162. So it will make it $10.40 become $10.56. As simple as that. So we will just summarize all of the grid index before we move on. And you can see that actually there's only three effects that it plays. For the first one, the delta is actually speed up the growth of the options value based on the increase in the share price. And the gamma will be the acceleration to that speed. And then the theta is actually the only opposites. As you can see, most of them are actually increasing the options value, but theta itself is actually depreciating the option value across time. The last one, Vega, will speed up the options value based on the implied volatility. So if you understand all of those, I think we can just move on to how to use this information that we learned to build our own strategy. Okay, let's see how do we able to build a strategy based on those that we have learned. Now, let's talk on strategy. Let's talk on how do we utilize all the great knowledge that we learn and build out our own strategy. Especially when you are working with a smaller account with a limited capital, you need to understand the characteristic and the challenges for small account first. For a small account, you'll be very sensitive to losses. A few losing streak might quickly diminish your account balance. So it will create a pressure on every trade that you take. So that to avoid this, we actually need a defined risk strategy. A defined risk strategy is actually a very strict risk management that can allow us to survive longer in the market. So we need a strategy that can fix on the potential losses on every trade. So after we know the maximum losses we can occur on every trade, we can just play along with it. Next, we'll be focused on only high probability trades. As the capital doesn't allow us to try and error, so that we actually need a relatively high winning rate to just grow our small trading account instead of blowing it. At last, we need to compound our gain. We need to compound those gains to just grow our account faster. We need to compound those gains since that small account need to grow, and the focus is to reinvest the profit to compound the growth. So it often by gradually scaling up the position size as the account balance grows. And I personally think that there is actually two ways of doing it. The first one I would say is flipping. Just flip 1x, 2x, 3x, or maybe higher. And then how do we do it? It's actually using LEAPS, which is called the long-term equity anticipation securities. Yeah, quite a lengthy name, but yeah, blah blah blah. It's actually just an option with the expiration date that is more than 1 year. As simple as that. Option with the expiration date longer than 1 year. And this is the justifications on why we only focus on the leads to flip the account. First, this is a single leg option. and we will only become the buyer. So the risk is now defined. Defined risk is achieved. As the maximum losses it will cause is only the premium that we pay. So now that we increase the probability, the winning rate, first of all, we need to choose the leads with the delta between 0.5 to 0.7. There's two reasons for doing that. First, you will get to enjoy more increase in the option value as the share price increase. Remember that for every dollar in the explanation of delta is that for every dollar increase in the share price, the option value will actually increase by the delta value. So that in this case, if you are choosing a 0.7, when the share price goes up by $1, your option premium is actually goes up by 70 cents. So you will get to enjoy the more increase in the option value as the share price increase. Second, if you remember that what I said previously, delta is actually have another meaning, which it represents the winning rate of the options to be in the profit at the time of the expiration date. So, of course, the higher the better because it represents the winning rate of the particular options. So in this case, we are only focusing on the delta of higher than 0.5 so that we make sure that our winning rate is actually higher than 50%. Next, we will need the implied volatility to be lower. The reason of doing this is because of the Vega. Vega will speed up the growth of the option value based on the increase in the implied volatility. If you remember that the fourth grid index that we are talking about, the Vega, for every increase in the implied volatility, the Vega will actually increase the option value, so that if you are choosing the implied volatility that is already at a very sky high level at the time that they were purchased, actually you left no room for the Vega to help you. We will need to make sure that we have every grid index to help us. We need to make sure that we can be the friend of those, and then they can help us to build a more favorable position. Last, we will need the expiration date to get as further as possible, minimum 1 year. This is what we call leaps, because leaps represent the options with the expiration date more than 1 year. This is to avoid the depreciation caused by the theta. The theta will depreciate your option value as the time passes. You remember that this is the only depreciation caused by the grid. So that with all these criteria, you actually make sure that you have a defined risk and a high winning rate strategy. So for the last one, when you are choosing the expiration date more than 1 year, as the time passes and the further out the expiration date, the smaller the data effect will be, so that the depreciation will actually go slower, so that you can actually enjoy the increase in the option value. And then hopefully with the criteria of those, the increase in the option value with the help of the delta and also the Vega can actually cover the depreciation caused by theta. So we minimize with all of those, you make sure that the delta and the Vega is on your side, and you get to minimize the depreciation of the data. This is the criteria that I filtered up to just create a high winning rate strategy to flip the account. So if you prefer the other way, we can actually do it with one small hint. In the next week, we actually do have a Chinese class that is talking about how do we use leads in the actual life cases. It's kind of like a practical classes. So if you need the link, and if you can understand Chinese or Cantonese, I believe that there will be a Cantonese sections too. So if you're able to understand Chinese and also Cantonese, you actually can contact me to get the link to access to those webinar. And then it will talk, another lecturer will just teach you on how to do the leads in the real life cases, and then he will just lead you through very practical classes. So I will just the same. I will leave my contact at the end of the sessions. So if you want to access to those webinar, you can just contact me. So if you prefer the other way, instead of flipping, you can actually do it with the spread option to just accumulate the gain and the growth and grow the account in a more steady way with a lesser risk. But we only do it with debit call or the debit put spread. This is actually same as a single leg method, which we only buy the call or only buy the put, but we open another short position at a different strike price to just reduce the premium that we pay, because when sometimes you buying a call options and put option might be very costly. So although it will open another position will limit the potential gain, but in this way, we will require smaller costs in buying the options and riding the trend, because we open another short position to get the premium for the market. And then we can use the premium that we get to cover part of the costs in buying the options. So here is a little small hint. We can actually adjust the gap between the we can actually adjust the gap between the strike price to adjust the risk to reward ratio. And this is actually a more advanced strategy compared to just a single leg options. And I personally will have another advanced strategy classes, free classes next week. So if you want to know more about the advanced strategy, we will be applying on the volatile market and also apply on the ranging market. There's actually different strategy fit for different market situations. So we can just try to get benefit from whatever market that is happening right now. So if you want to know more about the advanced strategy itself, stay tuned for the next week classes. I will talk on it. So now now let's move on to large account. So what if we have a large account but not a small account? We can actually become the selling party of the options to earn the premium. If you do follow my last class, we have explained that why selling options is a more favorable it's a more favorable compared to buying option. Selling options is actually the only way that you can earn the premium compared to other financial instrument. So if you miss that class, which we are talking about the beauty of being a selling party. If you miss that class, I will have another class next week, but it will be in Chinese. So the Chinese class will also talk about being in the selling party to enjoy to make money from the premium, and then we will in the other way we can also limit our risks. So if you can understand Chinese and you missed the previous class, you want to know about the benefit and how do we in the more favorable positions on being the selling parties, you can actually contact me to get the link to access to the Chinese class on becoming a selling party. So still the same, you can just contact me after the classes. I will share my contact at the end of the class. So back to it, back to the content. Since we are going to become the selling party, we can actually do the cover call writing, the cash secured put, and the iron condo. This is majority focusing on selling the options to get a premium. And then all of those are actually focused on selling the options. So, but we also need to diversify our portfolio, as one of the characteristics of selling options is that we might have unlimited losses behind the premium that we earn. So we need to make sure that the portfolio is diversified, so that even though the winning rate of being a short selling party is higher, even the bad things happen, you get to lose in one of the options that you sell, you also can cover the position with another selling positions. So this is how we're going to select options to sell. First of all, we will need to diversify our portfolio by trading multiple stocks instead of just pumping all the money, all the capital into one of those. So we can just allocate our capital and then trading and or investing into multiple stock options. And how do we make sure that we are having a higher probability? First of all, it's just exactly the opposite of the previous, since that we just want the opposite way. Since that we are selling now, we want the opposite way, which is the delta below 0.5, which make the buyer winning rate is lower than 50%, so that it can favor ourselves. Because the delta is representing the buyer winning rate. So with the delta of lesser than 0.5, it mean that we as the selling party is actually having a winning rate higher than 0.5, higher than 50%. The second, higher IV as much as possible. The higher the IV, the higher the options value. So the premium that we gain from the selling will be much more higher. And the higher IV will also make that there will be lesser room for the Vega to take place and to increase the option value. So that when we are selling, we are make sure that we are selling at a higher price, and then we want to buy back at the lower price, sell high and buy low. Or we can just wait until expiration without buying back. This is how we become a selling party. Last, a closer expiration date. So the closer the expiration date, the data, the grids, the third grids, the data will be actually much more higher. So the option value will then depreciate faster, and we are able to sell high first and then buy low after a few days to just lock in our gain. So you can see that actually the criteria is just the opposite of being a buying party. We want a lower delta, a higher IV, and a shorter expiration period. And when we are doing it in a buyer position, we're actually looking for, as you can see, actually we are looking for a higher delta, a lower IV, and a higher expiration date. So this is how we are going to just grow our small account and also make some gain from the large account. Since we already understand the grids, and then we make sure that we are on the same side of the grid, or we can just utilize it and then minimize the bad effect, the negative effect. So that will be, let's check on the time now. It will be 8:46 now, and it will be the end of our classes. And here I share my personal contact. You can contact me through WeCom, which is you can just use the WeChat to scan, or you can contact me through WhatsApp personally. And then there will be classes on next week, which one of those are talking on the practical class of leads, which is the method of flipping the small account. And also there's another classes by me, which is talking about the beauty of being a selling party to earn the premium. So if you are interested on those two classes, you can actually get the link access from me. So let's see if you want to know the theory first, or you want to just go to the practical class strict and direct. But those classes will be in Chinese. So make sure you can understand Chinese before you go. And then this is my contact if you want to contact me. Next on, I will just share the benefit of being a U-Smart party at the end. Now, if you open an account, you can actually receive a Tesla share. And then when you deposit more money into it, you can actually get more cash voucher. And then this will be the QR for the registration. So feel free if you want to register through this QR, and then we can just make our game together. And then here come the end of the free webinar. If you have any question, feel free to raise now, and then I will just answer you by right. So if there is no more questions coming in the next 3 or 5 minutes, we will just end this webinar earlier so that everyone can enjoy their weekend earlier. Yeah, happy Friday. The Friday night is still long. So yeah, at last, let me show you the disclaimer. So if you have any question, feel free to raise to me, and then we will just let's see. I saw a question. 改天讲一期中文的，谢谢。呀，中文的一定会讲的，只是看看那个课程安排的怎么样，因为我们中文的导师会比较多，所以其实你可以留意一下，我们会有每一个星期我们会有一个时间表，然后是说哪一天是有什么课之类的。然后不用担心，我们会有中文课的。So to check on if you understand all the theory, and also if there's no more questions, and then in next week we will be sharing on how uh the practical classes of the leaps, which is how to flip the account, and also the beauty of being a short selling a selling party. And otherwise, we also talk about how to the different advanced option strategy for different market. The strategy for the volatile market, and also the strategy for a ranging market. For now, it's considered a volatile market due to the US elections. So it's actually the option selling now is actually having a quite high IV. And if you become a selling party now, you can actually make a lot of premium from it. But you need to be careful on on the the risks. Any basic costs on options? Yes, there's actually a lot of basic costs on the options. And if you miss the previous classes, you can actually get the recording from the communities, or you can get from me. I will try to get it for you. And else you can just wait for another cycles, which after all these beginner classes is over, we will move on to the intermediate classes, and then we will have a cycle to just keep on repeating and just keep on to draw the people into the community. We will build the community together, and then we will just make some great money together. So either you can get the recording from the community or from me, else you can just wait for another cycle. But I'm not sure whether when the cycle will be in, because the schedule is now incomplete, I would say, because there's too much information or knowledge to share. Thanks for your interest. And yeah, you said that you didn't join me for the previous classes, which we will already go through the basic theory at the beginning. But yeah, if you are interested, feel free to just ask me any questions, and then we might schedule you a sessions to just talk about the topic that you are interested. Aside from options, you can actually we also talk about fundamental analysis, technical analysis, the news trading, which we already discussed in the previous classes, the method on how to doing it and the step-by-step agenda on how to conduct those analyses. So aside from option itself, if you have any topic that is interested, you can actually raise to us, and then we will just try to arrange a session to talk about it in detail. For now, all the courses are free, but I'm not sure whether in the future it will cost you any money or not. So do appreciate our effort, and I thank you for your joining. So if there's no more question, we will just end our webinar here. So thanks for your time and enjoy your Friday night. Hope to see you guys again on the next free weekly classes. So thank you. Thank you. Appreciate your time. Have a nice weekend and have a nice Friday night.